Today, we're going to be talking about the 60-day rollover rule. Have you heard about the rollover rule? A lot of people think rollover, they think retirement, and this is a retirement show, so it is relevant to people. But what is the 60 days? What does that have to do with it? And what if I don't know the rules? Is that good? Well, you should know, especially if you're going to implement or try to do a 60-day rollover. Let's bring in my co-host. Speaking of getting rolled over here, Tony, welcome to the show. Have you heard of the 60-day rollover rule?
Yes, I have actually. Yep, I've heard about that. I heard it can be quite tricky.
Yes, they made some changes in 2015, they being the IRS. So it made it a little bit more difficult to do, more rules, more problems, more penalties. Let's talk about it. So I know this is a very specific topic, so we can keep it tight. But I just want to mention that we had our last show, we had a guest on, and I'm going to bring another guest in here today when we're ready. But it'll be a bit of a surprise for you, Tony, because I think the last guest was a surprise, but this one will be even more surprising.
Oh.
Okay, so the 60-day rollover rule. It applies when you're moving qualified funds. So what is that? That's going to be a 401k, an IRA, 403b, 457, HSA, something that has some sort of tax structure, and you don't want to pay taxes, but you want to move it. The whole point of moving it, for whatever reason you have to move it, that's irrelevant. But the idea of doing a rollover, moving it over from one to another, is so you don't pay taxes. We're trying to avoid taxes
because those are tax deferred accounts. And so when you take money out of those accounts, typically the IRS wants to tax it, and there's rules about taxes. But if you roll it over into another type of tax deferred account, you can avoid paying taxes, at least at that time, on that money, is what you're saying.
if you do it right.
Right. If you do it right, that's why we're having this show, because it is a lot of people make mistakes when they do this.
And I'm going to tell you about a recent episode I ran into with someone that didn't do it right.
Oh no.
And is really up against it now. And it happens.
Yeah.
People just make this mistake. So let me start off by first explaining how the different ways you can move money. Okay. And then we'll get into the 60-day rule. So there's basically three ways that you can get money from one account to another. And let's say it's just an IRA to an IRA. And you don't want to pay taxes, right? So you want to move it from Schwab to Fidelity, or you want to move it from your old 401k to your personal IRA that you have at the bank or whatever.
That's a common one,
right? So there are certain ways you could do it. I would say not necessarily the most common and the least risky is to do what's known as a direct transfer. And if you're not in the industry, you may never heard this term, but if you're in the industry, this is what you want to do. And so if you ever in a situation where you want to move money from one IRA or one qualified account to another, ask to have it done direct transfer. And what that means is it's trustee to trustee transfer. So you say to whoever has your money, the custodian, say, I want you to send the money over to company B. So company A, send it to company B and don't involve me. I'll sign off on it. You guys figure it out. And they do. And they send it to each other, and you never see anything until the money's gone from your first account, and then it magically appears over here. And so that's called a direct transfer. And
no taxes, no penalties.
Right. Exactly. The two companies handle it. They let the IRS know what's happening, and you don't get involved besides watching the money move.
There's no money withheld.
No taxes withheld. It's just a whoop, move over. That's the best way to do it because you don't run into mistakes. Now, if the companies make a mistake, well, that's on them and then they could be fixed. But that's called a direct transfer or a trustee to trustee transfer. Sometimes you can't do that. In fact, when you have a 401k, a lot of them say, no, we're not going to send it directly to wherever you want it. We're going to cut a check. And so
I've had that
that's when it
happen.
becomes a rollover.
Yeah.
Now, there's two types of rollovers. There's a direct rollover and an indirect rollover. Direct rollover is when say it's a 401k and it's sending it to your IRA. A direct rollover would be 401k company. You call them up and say, I want to move it over to my personal IRA. They say, sure, no problem. Did you read the tax rules? That everyone will ask anytime you move money from a 401k, they're going to ask you, did you read the rules? Have you received that IRS form that explains all the rules? They're required to ask you that. You say, yeah, sure I did, right? Because most people say, yeah. What they're doing is they want you to know that you can make a mistake here. For most 401k companies, they will cut a check directly made out to wherever you want it to go. Hey, can you cut it to my IRA over at Schwab? Sure. So what they do is they write a check out for whatever the amount is and then make it out to Schwab. Not to you, to Schwab. So you can't cash this check if you wanted to. Well, it's my money. Why are they making out to Schwab? They make it out to Schwab and then they put FBO, Tony, right? And that means for benefit of. And they put your name. So, and you get that check. And a lot of times they'll say, we're not going to send it to Schwab. We're sending it to you. You get it to Schwab. So next thing you know, you got a check for $100,000 made out to Schwab for your benefit. And you're holding it. And you're like, well, what am I supposed to do with this? You send it to Schwab. That is called a direct rollover. The reason why it's still a rollover because it's rolling from you in your hands to them. And it's made out to the new custodian. So it's not made out to you. It's made out to them.
Yep. But there are mistakes that can be made with that one.
Well, you can lose the check, or you can not put your account number on the check or something like that. But there's not going to be any tax held on that.
Sure.
There's going to be no tax held on that. So that is important to note. The problems arise when you do an indirect rollover. And a lot of people who just don't know, or they just say, all right, whatever, their current IRA will send them a check made out to them, and then they can't do anything but cash it or endorse it or whatever. They need to have in mind that they have 60 days to then move it, or else what? And this is a perfect time to bring in my new last time we had Amelia. This time we have Humphrey. Humphrey, welcome to Dolphin Financial Podcast with me and Tony. How are you doing today?
I'm doing quite well, thank you. It's a pleasure to be part of the Dolphin Financial Podcast with you and Tony. How can I assist you today?
Today we're talking about indirect rollovers versus direct rollovers and the 60-day rollover rule. Can you explain the difference between a direct and an indirect rollover?
Certainly. In a direct rollover, the funds are transferred directly from one retirement account to another without you handling the money. This method avoids taxes and penalties. In an indirect rollover, the funds are given to you first and you have 60 days to deposit them into another retirement account to avoid taxes and penalties. It's important to be cautious with indirect rollovers, as missing the 60-day deadline can lead to tax liabilities.
What is the penalty of missing an indirect rollover 60-day rule?
If you miss the 60-day deadline for an indirect rollover, the amount not rolled over is typically considered a distribution. This means it could be subject to income tax and, if you're under 59.5, an additional 10% early withdrawal penalty. It's crucial to adhere to the deadline to avoid these potential costs.
You see, Tony, there was something there, taxes and penalties. Taxes we get because it's a distribution, but the penalty gets people under 59.5. So if you're doing an indirect rollover, you want to make sure that if you're under 59.5, you do it because not only will you pay taxes, you'll get hit with a 10% early withdrawal penalty. So
right. And there used to be a 50% additional penalty, right? If you didn't do it. Was that on the
that was on RMDs. That was
that's the RMD distribution. Yeah. Okay.
So the key is you're taking possession of the funds.
Yeah.
So why would anyone do this? Why would anyone bother? Well, a lot of people do it because they want that money to do something else in the short term. So they have a 60-day need. And this is where you run into trouble. But in 2015, they made a very important change to the rule, which talks about how many times you can do this. So the new rule, I'll call it new, in 2015, that's 10 years now, Tony.
Wow.
Holy smoke.
Time flies.
This is a quote from the IRS. Beginning after January 1st, 2015, you could only make one rollover from an IRA to another or the same IRA in any 12-month period, regardless of the number of IRAs you own. End quote. So let that sink in, and let's bring Humphrey back in to say it in a British accent, because maybe he'll give us a better idea. Hey, Humphrey, how many 60-day rollovers can you do at a time?
You can only do one indirect rollover per 12-month period per individual, regardless of how many IRAs you have. This rule helps prevent the abuse of the rollover process.
Ooh, prevents the abuse of
Wow.
the rollover process.
Wow, he even gave us the reason.
Well, what is that abuse? The abuse is people using it as a little piggy bank for short-term loans. That's really what. So,
sure.
Now this doesn't apply to conversions. So when you're doing a Roth conversion, you could do as many of those as you want. The 1 per year, and it's not per calendar year. It's per 365 days, 12-month period. So if you do a rollover in January, you can't say, well, I can only do, or if you do a rollover that's a bad example. You do a rollover in August of 2025. And then you're like, well, that was my one for the 2025. And then January 2026, you do another one. You've effectively broken the rules. You've done more than one in a 12-month period. You're out. You're going to be paying taxes on the whole thing. The whole thing.
Wow.
That doesn't apply to conversions. So you could do as many conversions as you want, which is basically taking IRA money and moving into a Roth IRA. So that's a rollover, really, but it's conversion, but you're paying the tax on it. Trustee to trustee transfers. That's the key. You want to do that. You could do as many of those as you want in a year, in a 12-month period. You could do IRA to plan rollovers. Not many people do that. Do you know that? You could take your IRA that you have, your personal IRA, and move it into your 401k wherever you go. Like, say you're going to new job. You could take that. Not every 401k allows for deposits like that, but most do. The same reverse. You could take it from your plan, your 403b, and move it into an IRA. You could do as many of those as you want in a 12-month period, as long as it's direct, not indirect. And same with plan to plan. So you can move from IRA to an IRA, like they can talk, like a 401k to another 401k at a different company.
So the 401k, to roll it over into an IRA, the 1 year limit doesn't apply to that. You're saying
The once per year limit does not apply. So you can do 5 401k to IRAs as if you want, as long as it's direct, right? They cut the check directly.
So it's only from an IRA to an IRA then?
Indirectly, right.
Yeah,
so you could do a trustee to trustee from an IRA to IRA. You could do many of those you want, but it's this indirect, because they don't want you taking possession of that money.
Oh, and earning interest off it for any period
doing
of
whatever,
time.
doing whatever you want with it.
Yeah, it's like a loan. Yeah. Then.
So I'll tell you the story that I'm dealing with is I have a client that was moving, and they were selling their house and buying a new one, and they needed money to buy the new house. Not much. I think he borrowed $40,000, or took $40,000 out of his IRA with the intention of putting it back within 60 days when he closed on his other house, got the money, blah, blah, blah. Well, as soon as you do something like that, the clock starts ticking. In fact, that's a good question for Humphrey, because I want to confirm that.
You create a tax event.
Hey, Humphrey, when does the 60-day rollover rule begin?
The 60-day rollover period begins on the day you receive the distribution from your retirement account. It's important to keep track of this date to ensure you complete the rollover within the allotted time.
But what if you get a check mailed to you? Is it the day you receive the check or the day you cash the check?
The 60-day period begins on the day you receive the check, not the day you cash it. It's crucial to act promptly once the check is in your hands to ensure you meet the deadline.
So in this case, the guy got his check, but it took him a while to cash it. But technically, he received it on one day, and he has 60 calendar days, not business days. So then it was, I got to get that money in, but it was on a weekend. It was chaos, right? Because he managed to get it in. But what if he didn't? Then what? It would all been taxed. It would all been like, hey, you took a distribution for 40 grand. Now you owe us taxes on that. Imagine someone doing this for 300 grand. And
yikes.
That year, boom, they get hit with it.
And isn't there, you haven't touched on this. I have a question for Humphrey, actually.
Go for it.
Humphrey, if I roll over from an IRA to an IRA and the 60-day rule applies, do they withhold any money to cover taxes?
In an indirect rollover from an IRA to another IRA, the financial institution typically does not withhold taxes. However, if you're rolling over from a qualified plan like a 401k, they may withhold 20% for taxes. You'd need to make up that withheld amount from other sources to avoid taxes and penalties.
Yeah, that happened to me once when I rolled a 401k over. I didn't know about the 20% rule.
So let's talk about that.
Oh, you were ready. You had it all queued up.
It's key. So when you move an indirect rollover from an IRA to an IRA, you're probably not going to say withhold taxes because
no,
I'm planning to pay it back, right? Or I'm planning to move it in 60 days.
Yeah.
But a lot of times your 401k company, your 403b might say, we have a required 20% withholding. And you're like, well, I'm going to roll it. I'm going to put it somewhere else. They're like,
Right.
I don't care. This is our rules. Deal with it. What do you do then? You just got to eat it. You just got to say, oh, I got 20% going to the government. No, what you do is let's use an example, Tony. Let's say it's $100,000. Let's say you're moving your 401k and you're moving it to your own IRA. And the way it works is it's going to be an indirect rollover. They're cutting the check to you and giving you 60 days. For whatever reason, you decided to do it that way, right? They said, well, mandatory 20% withholding. All right. So now you get a check for 80 grand. And you're like, well, I wanted 100. So you could take that 80 grand in 60 days and put it in. You could also take 20 grand from somewhere else if you have it, you know, rich uncle, and put that in. So you could put 100K in. And you're like, well, then where's the other 20,000 gone? The IRS has got $20,000 of my money. Yeah, they do. So when you file taxes, you'll have a prepayment of 20,000 or a credit of 20,000 toward your taxes, and you'll get it back during tax time. Or in your case, Tony, you'll have prepaid the hundreds of thousands of tax dollars that you owe every year.
I don't know that. In order to owe that much money to the IRS, I would have had to make more money than I make as a radio show co-host, Dan.
There's a question for Tony, for Humphrey. Let's bring him back. How should I phrase this? Hey, Humphrey, do you know what the average radio show co-host is in the United States?
I'm afraid I don't have the specifics on the average salary for a radio show co-host in the United States right off the bat. However, I can look it up for you if you'd like. Would you like me to do that?
Yes.
Just a moment. Let me check that.
This is you asking, Tony. I wasn't going to have him look it up.
As of 2025, the average salary for a radio show co-host in the United States is about $53,219. This is a bit higher than that of a radio host, which averages around $46,944. The salary range for co-hosts generally falls between $27,000 and $104,000 annually. These roles often require similar skills and educational backgrounds, especially in communication and media-related fields.
I
Hey, Humphrey,
absolutely.
thank you very much for joining us on today's show. Hopefully, you'll join us next week. Have a good day.
Thank you for having me on today's show. I look forward to joining you next week. Have a splendid day.
So, Tony,
Yeah.
we went down that path, but
Well,
Humphrey's
Dan,
good.
I mean, I'm trying to point out that, your favorite radio station, the afternoon DJ, is not making much money. People think, oh, wow, he's famous. Nope.
Right.
That's why I'm working in the financial industry, Dan, and not,
That's
and
it.
not
That's
on an afternoon drive time anymore.
I'll tell you what, I'll send you a rollover check, Tony.
Yeah, there you go.
So, to conclude, the 60-day rollover rules are stringent. You need to follow them, and there are some exceptions. If you get sick, or if the custodians make a mistake and send the check to the wrong address, that's not on you. That you can apply for a grievance with the IRS and say, hey, here's my extenuating circumstances, and they will do it. But that can get expensive, especially if it's like you need to prove some stuff. You got to get a lawyer. You rather just follow the rules, and I would suggest just avoiding the whole idea together. They made the 60-day rollover rule to help the process of moving funds. They give 60 days to get the act together. It's not designed as a temporary loan. It's really they're trying to put that in there to prevent people from doing it. People do it anyway, and there's no fees, but it's a risk. So if you're going to do the 60-day rollover to borrow the funds for a short-term need, make sure you're in complete control of the timing. Because if you do
Yes.
something like buying a house and the buyer backs out, like you're selling yours, and the buyer backs out due to whatever, which we know happens all the time, maybe they get sick, maybe the funding falls through. Now you're in a real heap of trouble, because now you got to get the money back in, and you don't want to be there. So understand the rules, follow them, and avoid any trouble. That's the way I'm going to go with it.
And avoid the indirect rollover. Do a direct and work with a financial professional, someone like yourself, and run it by them and have them help walk you through the process.
That's it.
Yeah.
Well, Tony, thanks for a great show. Hopefully you liked Humphrey. Who did you like, Humphrey or Amelia? Because
Humphrey by far.
Humphrey?
Love the voice. Yeah.
He talked a little slower. Well, maybe we'll switch to this side of the pond next time with a different voice. So, thanks for a good show.
Yeah.
Yeah, it just has more gravitas. So enjoy the rest of the week, and we'll catch everyone next week. Thank you.
All matters discussed in today's show are for informational purposes only.
This show is not investment advice.
Dan Riddle nor Dolphin Financial Group are affiliated or endorsed by any government agency.
Investment advisory services are offered through Dolphin Wealth Management, Inc., a registered investment advisor in the state of Florida.
Insurance products and services are offered through Dolphin Insurance, Inc.
Dolphin Wealth Management, Inc. and Dolphin Insurance, Inc. are affiliated companies doing businesses as Dolphin Financial Group.
You should talk to someone at Dolphin Financial Group before implementing any of these strategies or ideas.